Hey guys, welcome back to 90 Seconds with Chris. Today we're going to talk about stocks and bonds, how they work together in the real world. At this point, we agree there's pretty much two main ways for a company to generate capital or raise money for whatever they may need to. The first way is by issuing stock. This allows other people to become part owners of the company by giving them equity to the shareholders. The second way is by issuing bonds. This allows other people to become creditors of the companies by giving out I.O.Us to these bondholders. Most companies in the real world actually use both methods to raise money, as this has been proven to be better than using only stocks or bonds. Let's go back to my bakery. I needed $10,000 in startup costs, but I only had $2,000 in my savings. As a result, I definitely need to raise the difference of $8,000. To do this, I decided I'm going to do a 50-50 split between raising $4,000 with issuing stock and $4,000 by issuing bonds. I sell 4 shares to investors at $1,000 per share. I also go ahead and sell 4 bond notes to a different group of investors at $1,000 face value per coupon, a 10% yearly interest rate, and a 10-year maturity date. This currently means I own 1/3 of the company, which is gotten by the $2,000 I put down divided by the $6,000 all the shareholders, including myself, put down. Fast forward 10 years, business is booming and our bakery is currently worth $1 million. I pay off my creditors since the bond has matured in 10 years and we're left with $1 million we're minus the $4,000 we paid in annual interest over the 10-year span, minus the $4,000 we paid at the end of the maturity date, which is $992,000. At this point, I still own 33.3% of the business, which is worth $330,000, and each of my 4 shareholders each own 16.6% of this business, which is worth $166,000. Now creditors can go on their way because they've been paid off, and the shareholders can do with their shares as they please.